Hello, everybody. At this time, we are talking about the money market. The money market refers to trading very short term debt investment and often involves continuous large volume trades between institutions and traders at the wholesale level. The money market is characterized by a high degree of safety and relatively low rates of return on investment. And then we move to functions of the money market. There are the main functions of the money market. The first function, financing trade. The money market provides financing to local and international traders who are in urgent need of short-term funds. It provides a facility to discount bills of exchange, and this provides immediate financing to pay for goods and services. And then second, growth of industries. The money market provides an easy avenue where businesses can obtain short-term loans to finance their working capital needs. Due to the large volume of transactions, businesses may experience cash shortage related to buying raw materials, paying employees, or meeting other short-term expenses. And then third, central bank policies. The central bank is responsible for guiding the monetary policy of a country and taking measures to ensure a healthy financial system. Through the money market, the central bank can perform its policy making function efficiently. And fourth, commercial banks' self-sufficiency. The money market provides commercial banks with a ready market where they can invest their excess resources and earn interest while maintaining liquidity. Short-term investments such as bills of exchange can easily be converted to cash to support customers' withdrawals. Also, when faced with liquidity problems, they can borrow from the money market on a short-term basis as an alternative to borrowing from the central bank. The advantage of this is that the money may charge lower interest rates on short-term loans than the central bank typically does. And then we move to features of money markets. The first feature, liquidity. Since these instruments are highly liquid, they allow easy access to funds for investors. They can also be bought and sold quite easily without affecting their market value. And then second, short-term financing. Money markets offer different entities like governments, corporations, and institutions a safe and convenient way to meet any short-term financial obligation and manage their liquidity. And then third, safety. These financial instruments are generally issued by trustworthy entities like the government or huge businesses with a solid reputation, which in turn makes them low risk. Hence, they are considered to be relatively safer than other short-term investment options that help with capital preservation. And then fourth, diversification. They offer an investor a great opportunity to diversify their portfolio. Investors can park their money in different money market instruments with varied rates of interest and maturity horizons to spread their risk and minimize exposure to any one particular asset or financial instrument. And then fifth, stable returns. Money market instruments are known for their stability and ability to preserve an investor's capital. They offer periodic and predictable returns or provide discounts on their maturity, making for decent investment return. And then, who uses the money market? The first, government. Governments often play a significant role in the money market. They issue money market instruments such as treasury bills to finance their short-term funding requirements. These instruments are considered highly secure, backed by the government's creditworthiness. And then second, central banks. They play a crucial role in the money market by conducting monetary policy operations. They use tools such as open market operations to buy or sell money market instruments to manage the money supply, influence interest rates, and stabilize financial markets. And then third, corporations. Large and tiny corporations utilize the money market to meet short-term funding needs. They issue commercial paper, which represents unsecured promissory notes to raise funds for operational expenses, inventory management, or capital investments. And then fourth, money market funds. These are investments that pool funds from individual and institutional investors. Professional investment managers oversee managing these funds, and they distribute the pooled funds among various money market instruments. Money market funds provide investors with a convenient way to access the money market and benefit from diversification. And then fifth, financial institutions. Banks and other financial institutions actively participate in the money market. They use money market instruments to manage their liquidity and meet regulatory requirements. Financial institutions also invest in money market instruments as a source of income to ensure the stability of their cash positions. And then we move to the types of money market instruments. The first, treasury bills or T-bills. Treasury bills are short-term Government securities with maturities ranging from a few days to a year. They are sold at a discount to their face value, and the difference between the purchase price and the face value is the interest earned by investors. The bills are considered one of the safest instruments because the government's credit backs them. And then second, repurchase agreements or repos. Repurchase agreements involve the sale of securities with an agreement to repurchase them at a higher price on a future date. Government securities typically collateralize these short-term loans. Financial institutions use repos to raise short-term capital and manage liquidity efficiently. And then third, commercial paper. Commercial paper is an unsecured short-term debt investment corporation used to meet their immediate financing needs. Typically, it has maturities up to 270 days. It is issued at a discount and redeemed at face value, providing a low-cost financing option for companies with strong credit ratings. I think it is enough. Thanks for watching.